Hello, we are the Group 3, and for our financial analysis presentation, our selected healthcare organization is the Hospital Corporation of America, or better known as HCA Healthcare. In our presentation, we will be discussing about the company's overview, the financial and operational overview, financial and operational analysis, our summary and recommendations, and last will be our references. Hospital Corporation of America, or HCA Healthcare, is an established for-profit healthcare organization that owns and operates hospitals and other healthcare facilities aiming to excel at their level of care and increase living improvements for their patients. It is founded in 1968 by father and son physicians Dr. Thomas F. Frist Sr. and Dr. Thomas F. Frist Jr. and businessman Jack C. Macy. They created HCA Healthcare with the vision of a company that would transform healthcare by applying business principles of scale to hospitals, all while keeping the focus on meeting the needs of patients. HCA operates over 150 hospitals and over 1,000 other healthcare sites, including surgery centers, freestanding emergency rooms, urgent care clinics, diagnostic and imaging centers, walk-in clinics, and physician clinics, enabling them to deliver everything from first-class cutting-edge clinical research to individualized patient health solutions. It is operating in 20 states in the U.S. as well as in the United Kingdom, and these locations are operated by over 300,000 colleagues and staff, headquarters in Nashville, Tennessee. HCA Healthcare is recognized as a national provider in the United States with an international presence as well, particularly in the United Kingdom, operating on both national and global scale. The company has faced a number of legal issues, including antitrust lawsuits, data breaches, and lawsuits alleging discrimination, of which the federal probe culminated in 2003 has been referred to as the longest and costliest investigation for healthcare fraud in the United States history. HCA Healthcare has merged with other companies in a number of ways, including acquisitions, joint ventures, and partnerships. The most recent acquisition was with Catholic Medical Center, a standalone multi-specialty hospital founded in 1892 and located in Manchester, which was acquired by HCA in December of 2024. One thing about HCA is that they differentiate themselves by placing a major focus on innovative technologies and strategies to improve patient care, and by their sheer size. And at HCA Healthcare, they are driven by a single mission, and that is, above all else, we are committed to the care and improvement of human life.
Next, we'll go over the financial and operational overview. One of the current competitors of HCA is Tenet Healthcare. Tenet Healthcare is based out of Dallas, Texas, and they currently operate 61 acute care and specialty hospitals, 164 outpatient care sites, and 484 USPI ambulatory surgery centers and surgical hospitals. Their current staffing is approximately 106,000, and that statistic is from their 2023 Environmental, Social, and Governance Report. Thus, HCA is larger than Tenet Healthcare. So HCA does recognize in their annual report that healthcare business is competitive, and many hospitals in the community offer similar services that HCA does. However, one of the biggest strengths of HCA is that they lean into value-based purchasing, as they recognize the impact that CMS has through the publishing of performance data, such as patient satisfaction, and the impact that can have on attracting patients both positively and negatively. They have a few risks, though, that they highlight that could impact their performance within healthcare. First, they have significant indebtedness with approximately $39.593 billion. and that is as of December 31st, 2023. Secondly, there's always the risk of human capital with staffing shortages, retainment of employees, and having qualified staff that they're recruiting. Next, there is the risk related to cybersecurity or data breaches, which could result in harm to patients, liability, and litigation. So looking at the revenues by primary, third-party payer classification, and other, this chart is pulled from HCA's annual report, and it shows the different types of revenue that they are receiving through third-party payment systems. As shown, these payments have been steadily increasing since 2021, and Medicare and managed Medicare has made up the largest ratio of revenue for HCA. HCA's current operating statistics are shown below in the chart that is also pulled from their annual report. As shown, the number of hospitals, admissions, equivalent admissions, emergency room visits, outpatient and inpatient surgeries has increased over the past 3 years. However, we have seen a decrease over the past 3 years in the average length of stay, average daily census, and occupancy rate. Next, looking at the stock performance graph comparison. Again, this is pulled from HCA's annual report, but HCA has stock that is traded on the New York Stock Exchange. For the stock, the average price paid per share for 2023 was $249.52, with approximately 3,647,073 shares purchased. Shown here, the stock performance of a $100 investment compared to the S&P 500 and S&P Healthcare Index has had a higher performance since 2021. It is important to note, while this is not indicative of future financial success, it does show how the past few years have been a very successful upward trend for HCA's financial stock performance. Overall, and like a quick summation of the financial overview, HCA's financial report and annual report has been showing upward mobility despite their high level of indebtedness that they have occurred, which is a risk for them. And within this next section of our PowerPoint, we're going to discuss the financial and operational analysis for the revenue cycle management and focus and forecast its reimbursement performance for the next fiscal year.
Moving on, let's look at the financial and operational analysis.
Let's begin by looking at profitability, how well each company turns revenue into profit. HCA's healthcare has a total margin of 8.07%, which is higher than Tenet's 6.38% and above the industry average of 6.4%. This means HCA is more efficient at generating profit. However, HCA's margin declined from 9.37 last year, which suggests rising costs and possibly staffing, medical supplies, and/or operations. If this continues, HCA may have to manage costs more carefully to avoid cutting into their quality of care. Tenet's lower margin shows that it's struggling more with cost control, potentially due to lower insurance reimbursements or higher expenses. Another key factor is non-operating revenue, the money hospitals earn from investments or government funding or business partnerships. HCA earns 8.17% of its revenue from non-operating sources, far above the industry average of 2 to 5%, while Tenet only earns 0.40%, meaning it depends a lot on their patient payments, which can be risky if patient volume drops. The difference gives HCA a financial safety that Tenet lacks. Liquidity measures how well a company can handle short-term financial obligations. First, let's look at days of cash on hand. This tells us how many days a company can operate using its cash reserves. HCA has 451 days of cash on hand, which is slightly down from 458 days last year. This suggests higher spending on operations, but overall HCA remains financially stable. Tenet, on the other hand, has 763 days of cash on hand, which is well above the industry average of 218 days. This gives Tenet a strong cash buffer, though holding on to too much cash instead of investing could mean missed opportunities for growth. Now, the current ratio tells us whether a company has enough short-term assets to cover short-term debts. HCA's current ratio dropped from 1.38 to 1.18, far below the industry average of 2.79. This suggests HCA may be relying more on their short-term financing. Tenet's current ratio of 1.51 is slightly better than HCA's, but still well below industry norms. So while Tenet has a stronger liquidity, both companies should improve their short-term financial flexibility. Now let's take a look at asset management, or how efficiently these companies are using their hospitals and equipment to generate revenue. The fixed asset turnover ratio measures how much revenue is generated per dollar of assets. HCA's ratio dropped just slightly from 2.36 to 2.34, which can mean new hospitals or equipment investments are not yet fully operational. Tenant's ratio is 3.29, which is above HCA's and the industry norm of 1.5 to 2. This suggests Tenet is using their facilities more efficiently, likely by seeing more patients per facility. The total asset turnover ratio, which looks at all assets, not just the fixed ones. HCA improved slightly from 1.15 to 1.16, staying within the industry norms. Tenet's 0.73 ratio is just below the industry norms, suggesting underutilized assets. So while Tenet is more efficient with its fixed assets, its total asset turnover suggests there may be room for improvement. So let's take a look at debt management, or how much each company relies on borrowing. First, the total debt ratio. HCA is 70.43%, which is well above the industry average of 31 to 32%. This means HCA relies heavily on debt to operate, which is increasing their financial risk. Tenet, on the other hand, is at 52.56%, which is lower than HCA's, but still above the industry norms. Now, the long-term debt ratio, which measures reliance on long-term loans, HCA's long-term debt is 39.80%, which is above the industry average of 29.10%, but still manageable. Tenet's long-term debt is 82.80%, which is extremely high and risky. This means most of its financial structure is dependent on long-term borrowing, making it very vulnerable if revenue drops or the interest rates increase or rise.
Continuing on, the times earned interest ratio shows how easily a company can pay its interest expenses using its earnings. A high number means a company is in a stronger position to handle debt. HCA's times earned interest ratio of 4.14 is within the average range of 2.5 to 5.5, meaning it has enough earnings to cover interest payments. Even though HCA has a lot of debt, it can comfortably afford to pay interest, which lowers the risk of financial trouble. Tenet's times earned interest ratio of 2.46 is much lower, which means the company has less room for error. If its earnings drop or expenses rise, Tenet could have trouble paying interest on its loans. If this happens, Tenet may need to cut spending, raise prices, or borrow even more, which could create financial stress. The DuPont analysis is a way to break down financial performance by looking at three key areas: profitability, asset efficiency, and financial leverage. This helps explain why one company is performing better than another. HCA has a higher total margin at 8.07% than Tenet at 6.38%, meaning it earns more profit per dollar of revenue. This suggests that HCA is better at managing costs and pricing its services. HCA also has a higher total asset turnover ratio at 1.16 than Tenet at 0.73, meaning it is more efficient at using its hospitals, equipment, and other resources to generate revenue. Tenet's lower asset turnover suggests that it may not be using its facilities as effectively. Tenet's return on equity of 19.60% is much higher than HCA's 9.33%, which might seem like a good thing at first. However, this high return on equity is likely due to Tenet's heavy use of debt, rather than strong business performance. Because return on equity equals net income divided by shareholders' equity, a company with a lot of debt as well as low equity will often have an artificially high return on equity. In contrast, HCA's return on equity of 9.33% is more stable and sustainable because it is not overly dependent on debt to generate returns. HCA is stronger in profitability, cash flow, and revenue collection, but has higher debt and slightly weaker asset turnover. Tenet performs better in asset efficiency and return on equity, but has issues with collecting payments and a high debt burden. Both companies should focus on cutting costs, improving reimbursement processes, and adapting to value-based payment models to stay financially strong. Revenue cycle management is crucial for both HCA and Tenet, as efficient billing and claims processing directly impacts cash flow and overall financial stability. HCA's days in accounts receivable remains at 53 days, which is above the industry standard of 30 days, but still indicates relatively stable cash collection and timely reimbursements. However, Tenet's days in accounts receivable is 73 days, which is significantly higher than both the industry standard and HCA's. This delay in payment collection suggests higher claim denial rates, slower insurance reimbursements, or inefficacies in claims processing. A long accounts receivable cycle can lead to cash flow issues, forcing Tenet to rely more on its cash reserves to cover operating expenses. To improve cash flow, Tenet needs to reduce claim denials, strengthen insurance verification, and improve coding accuracy. If Tenet does not address these inefficacies, it may struggle to adapt to Medicare's value-based reimbursement models, which prioritize faster, more accurate billing and better patient outcomes. Even with high cash reserves, Tenet's slow collection cycle could create long-term financial strain if insurance payment delays continue. The vertical and horizontal analyses show that almost all of HCA's revenue came from patient services in both 2022 and 2023, with a 7.86% increase from the previous year. However, net income dropped by 10.87%, even though revenue grew, because costs went up. Salaries and benefits increased 6.51%, and other operating costs rose 15.42%, likely due to higher facility or administrative expenses. In addition, HCA made $1.3 billion from selling facilities in 2022, but in 2023 it lost $5 million instead, which hurt profits. Interest expenses also went up by 11.32%, meaning debt costs were higher. Even though the company earned more revenue, rising costs led to lower overall profits. Looking ahead, HCA is better positioned to manage its reimbursement cycle efficiently, which will likely result in more stable cash flow and faster adaptation to industry changes. Since Medicare and private insurers continue to emphasize value-based reimbursement, hospitals with strong revenue cycle management will be in a better financial position. HCA's current billing efficacy and ability to manage accounts receivable suggests that its reimbursement performance will remain stable or improve over time. On the other hand, Tenet's reimbursement performance is at risk if it does not streamline claims processing and reduce accounts receivable days. If Tenet fails to improve, it may experience delayed cash inflows, increased reliance on reserves, and reduced financial flexibility. Over time, these factors could negatively impact profitability and limit reinvestment in operations or expansion. As healthcare reimbursement models continue to evolve, hospitals that improve billing efficacy, reduce claim rejections, and strengthen payer relationships will be in the best position to succeed. If Tenet does not take corrective action, it may struggle to remain competitive, whereas HCA is likely to maintain a stronger financial position due to its efficient revenue cycle management.
Summary and recommendations. Based upon our financial and operational analysis and research of the organization's industry, environment, and competition, a few of the findings were that HCA's financial analysis yielded favorable results in comparison to competitor Tenet Healthcare. On the screen, I've provided a few examples that have been talked over in our analysis portion. Additionally, not all findings in the financial analysis were favorable, and Overall, you have to take into account the type of operation and industry that HCA is and who they are serving. Overall, healthcare systems will always be in demand due to the nature of our human body needing treatment from illnesses, prevention of disease, and overall promotion of health and well-being. A SWOT analysis was performed in regards to the financial security of HCA, beginning with the strengths. Overall, HCA is a large operation with over 150 hospitals and over 1,000 other healthcare sites. This is a huge strength that HCA has on its side due to the need of healthcare entities. Another strength is the streamlined processes that can be found from the figures from the financial analysis, such as the total margin, which shows that HCA is still making a profit despite its total expenses. These streamlined processes then lead to effective business decision making. A big weakness to note for HCA is its high debt ratio, which is ultimately due to inefficient money managing. This basically says that HCA does not have the ability to pay off its debt and keep cash on hand. If it were to overcome this weakness, it would result in better financial security. Opportunities for HCA would include enhancing the patient experience, which overall would improve quality metrics, additionally reducing operating expenses to lead for more better financial security, and overall investing in technology. This investment could lead for better research and could overall call for better performance in the healthcare sector. Threats that HCA is facing in regard to financial security include security breaches, which would lead to high dollar legal fees. Additionally, staff retention is a huge threat that HCA is facing due to staying in line with competing markets. And overall, reducing overhead costs can cause for a more negative work environment that can be harmful to staff and its retention, so this could also be deemed as a threat.
To close our presentation, we will look closer at strategic models for HCA's revenue cycle management and recommendations our team has compiled for HCA moving forward. Strategic approaches to revenue cycle management are key factors when HCA is looking to address issues concerning payment delays and revenue loss, among other key factors. By developing and maintaining enterprise-wide strategic and operating models for the organization's revenue cycle processes, HCA will be allowed to further promote financial stability, efficiency, and reduce costs while operating, while also increasing positive patient experiences. Looking at the revenue cycle strategically first, focus will need to be shed on an openness and adaptability to market change. This can be a very important factor in creating and maintaining a competitive advantage when HCA is forced to adjust to new billing codes, insurance policies, and new payment models. Another strategic focus should be directed toward improved patient satisfaction and engagement metrics. By instituting and maintaining operating procedures that highlight transparent billing practices, accurate invoicing, and efficient handling of claims, HCA can further create competitive advantages. Shifting our focus to reimbursement models, HCA can operate under a few different models, such as fee-for-service or bundled payment plans. However, with improvements in their revenue cycle efficiency and function, HCA will flourish within their current value-based reimbursement model that is based more on the effectiveness of care provided and patient-wide satisfaction rather than just the volume of services they provide. Finally, our team has compiled some recommendations for HCA to further increase their financial and market strength. A weakness identified throughout analysis of HCA's financial reports is their debt, including above industry average levels of total debt and their long-term debt ratio. One way to tackle this would be by reducing their borrowing margin while continuing to increase their pre-tax income, which has shown a positive trend in the past years. Our second recommendation, as identified in the opportunities section of the SWOT analysis, is to devote additional resources and attention to operational aspects within the organization. One way to do this is by improving communication channels and information flow while embracing new AI capabilities by leveraging innovative platforms for patient engagement. By enacting strategies based on these recommendations in an already financially growing and stable organization, HCA will continue to be a growing industry leader.
These are our references. This concludes our presentation. Thank you for listening.